Good afternoon, ladies and gentlemen. Good morning for those of you still in London. This is Anil Walia from Deutsche Bank calling from Frankfurt. I'm very happy to be able to present running in line with the main theme of this conference this time, a different aspect to the ESG world and what's happening with it. I have with me a colleague and a partner, Wim from Ecovadis. We will be sharing our time on the presentation over here. To introduce myself, I am the European head for supply chain finance at Deutsche Bank. Been with the bank since 2006, finance business for above 12 years with JP Morgan, ABN AMRO, RBS, and now here at Deutsche. Very happy to be here. Wim, do you want to say a couple of words?
Sure, thank you. My name is Wim Peeters. I'm Vice President Business Development at Ecovadis. We're a rating agency, and we rate companies on how they perform on sustainability. I'm with Ecovadis from the start, originally as an investor, now running global sales, and before that I had various management functions in Ariba and Oracle before that.
Okay, thank you. So could we get the presentation on screen, please? Thank you very much. So here we go. Since the central running theme has really been ESG throughout the conference, we've been listening to some very interesting articles on financing and how the environment and protecting the environment and anything around that is become an issue. So here is kind of a summary of what I've been hearing and what we at Deutsche Bank are looking at in terms of a changing paradigm in the whole industry and in the whole financial industry as such. It's not just an issue of can we get cheaper financing on and off. It's become a marketing tool. It's become a tool of recognition. Our customers, whether it be the finance industry or it be the manufacturing industry, look at your cup of tea in the morning. Just look at the box out of which you take out the tea bags, and there will most probably be a statement over there in terms of how environmental friendly they are or how they are helping the farmers fulfill those requirements. So it's touching us at every point. We've heard a lot about ESG related loans. We look at a little bit about the physical world, the world of manufacturing, the world of the physical supply chain. It affects us all, whether it be if you look at shoes these days, if you look at some of the sports brands, they're all coming up with shoes which are made out of recycled plastic, or there are bits and pieces that are coming out of plastic that's being picked up on the sands of the various seas. So it is not something which is exotic anymore. It's catching up. There are tens of trillions of global capital already looking at the ESG element into their investment decisions. Our customers and our suppliers, our customers and our employees rather, are being increasingly sensitive to a company's role in the environment. So that becomes one part of how the industry is changing, how financing in itself is changing. What we need to look at is the bigger companies, the larger MNCs, shoulder a larger part of the burden of moving things in what we might want to call the right direction. And that's where supply chain finance has been coming into its own step by step. There are a few green programs known to be out there. Puma started off with one, Nike has one, most of the clothing manufacturers, design manufacturers have got programs running like that. The idea being, are we able to I'm just moving the screen. Sorry, guys. Yeah, there it is. So the idea being, is it just about profitability? Is it about, or is it about doing the right thing? And is it just something that is going to be the responsibility of the industry, or is there more coming up? And on this slide, you will see uh, how much to what extent the regulator has gotten involved in the activities of companies where it's not just about regulation of how things are done, but in terms of the regulator who has become more and more involved and and ESG is becoming part of that. It is becoming existential, for all of us over here. So going down to supply chain finance now. So the bigger companies, the MNCs, have got the market power, have got the purchasing power to influence in a positive way, how not what they do themselves, but how what their suppliers are doing. As a result, so to say, getting a knockdown effect to the larger to the larger environment and larger part of the world, where there may not be an automatic incentive within the area that they are operating to fulfill to fulfill certain ESG behavior, what we might consider as correct. Uh, there are obviously they have their own economic reasons for doing that. If look at the most of the manufacturing countries where goods are coming from, whether it be Bangladesh or India or China, um, the standards that the supplier over there, to fulfill some of the standards that one would expect to be able to do it in the European or the American context, would be a bit more difficult for them. So we are able to, through using supply chain finance, provide them an incentive, and the incentive could be is a financial incentive. There are other aspects to it, to be able to, so to say, try to change the world, try to improve the world. Big words, but this is where it's going. After all, that's what the legacy we're going to leave back for our children here, right? So it's not just about the moralistic issue about it. There are definite financial gains to be had, but not just from the fact that there will be cheaper financing to be obtained, or it will improve there will be a tendential improvement in the share price of companies who are seen to be as more green. But the larger knock-on effect does show benefits that are going into areas which would normally not have taken the initiative to do it themselves. For those of you who may not be familiar with supply chain finance or supplier finance, one short slide over here. What is supply chain finance? The supplier is issuing an invoice. The buyer is paying him in 30 days or 60 days, and the supplier needs to wait for 60 days for the funds. He has to borrow the funds for his working capital from his own sources. And if you look at again, just taking India, China, Indonesia, Bangladesh, the cost of funding over there is in the range of 10 to 12%. So in a supply chain finance world, a bank will get involved in the chain between the buyer and the supplier, and provide funding to the supplier based on the risk of the buyer, assuming that the buyer is a larger company with a better rating. The cost of funding that is provided to the supplier is a lot cheaper than his own funding sources. Now, within the ESG context, it is possible to have a differentiated pricing range for the suppliers for discounting their invoices, and the pricing range can be fixed in such a way that there is an incentive to move down the green ladder. However, it is not just about providing them cheaper financing. The companies who have an ESG agenda within their supply chains are incentivizing the suppliers in several different ways. They are supporting them in trying to become green. They are supporting them with training. They're supporting them with education. So there is a bit of a carrot and a stick. One doesn't like to talk about the stick, but there is definitely an element of that. There are a few clients of mine who have openly declared that if a supplier of theirs is not willing to improve on the scale, then that supplier bears the risk of not being a strategic supplier of the client anymore. So there is a stick there, but it's not, obviously that's just not enough. It's also about supporting them with the right kind of resources to help them move in the right direction. So how would the pricing be differentiated? And that's where WIM and Ecovadis would come into play. The bank, the buyer, and Ecovadis would work in conjunction with each other to provide on a scale, provide a rating on a scale from 1 to 5, as an example of how green or how environmental friendly the supplier is operating, and then put into place a regular review process, and within the review process also help the supplier to take the right decisions, to do the right kind of things. One incentive becomes, the better you go up the green scale, the better is the pricing for you. And there are other incentives that can be brought into the program. The key point over here is that the bank will work in conjunction and within the larger ESG program of the buyer to support that in the way that is appropriate for that particular industry. So if you're looking at the tea industry, buying tea from Africa, for instance, there is a different requirement over there. If you're looking at the textile industry, buying cheap textiles or cheap clothing from Bangladesh, obviously there's going to be a different layer over there. For the manufacturing industry, there's another thing. And it's not just about the environment and trees and the birds. It's also about women's rights. It's about children's education. It's about allowing mothers, in a large manufacturing facility to have the right to go and feed their infants, at a time, having separated toilets or having toilets at all, making sure that there is, there are fire extinguishers and fire escape positions placed anywhere. So it's not just about the air we breathe; it's also about the people who exist, on this planet, to be able to help them. This should not sound preachy at all, because as my son keeps telling me again and again, that's the environment that he is inheriting from us. Thank you. And with that, I will hand over to Wim.
All right. Thank you, Anil. Yes, I'll dive straight into a few points I could make about why ESG is now growing in attention for the financial world, specifically in supply chain finance. Let's see if I can change the slides. Okay, there we go. So yeah, there's a lot of strong drivers lately to that force financial institutions and your clients to focus more and more on ESG. And so more and more regulatory trends coming out. I mean, 10 years ago, we had the California Supply Chain Transparency and Supply Chain Act. We had the Modern Slavery Act in the UK, which is being copied and implemented in many other countries now. We have a devoir de vigilance in France. And more new regulations coming out, particularly for Germany, on a similar devoir de vigilance type of regulation. And there's a new taxonomy coming out for banks, telling them how they can use criteria to make assets on their balance sheets more green, etc. So I think there's also a lot of cash around where new investors in financial products are looking for products they can invest in, provided that there's a green or sustainable label on it. I'm thinking about pension funds, asset managers, private equity is looking for investing in other sorts of products than only publicly listed stocks or bonds that are rated on ESG today already. So yes, there's a lot of opportunity for the banks to jump into this. The problem is, of course, how do you determine whether an investment or a product is sustainable? Some other drivers we see, there's of course the climate change issue, which is becoming harder and harder for a lot of people in Australia, in California, but even the River Rhine and the water levels are impacting businesses today on how they can operate in terms of getting product to or away from the factory. And there were the Sustainable Development Goals brought out, to which a lot of your clients in the banking industry are aligning themselves and reporting on how they are impacting which SDGs. So I think it's important for you as bankers to understand in what kind of context your clients are operating. You know, with the ESG perspective or the CSR perspective, they're looking to see how they can reduce their costs, how can they focus on making sure their inputs and costs are not as much impacted on all these ESG-driven potential cost increases and taxes going forward on fossil fuels or other, right? How can they mitigate the risk? You know, more and more consumers today don't accept bad practices in the supply chain of your clients, but also together with that, the world has become a lot more digital. So not only don't they accept these practices, but the moment something happens, the next day they'll have it on their laptop or mobile phone, and it will be calling you about the practices in your company. But also, how can you enable your clients to make sure that they can tap into innovative practices that exist in the supply chain with their partners? How can we get that information to your clients so they can do better decisions? How does that come into ESG? The problem with ESG ratings in the financial world today is that, well, there's a lot of ESG rating agencies out there, but they are limited to rating the top 5,000 clients out there that are listed on a stock exchange in function of selling those ratings to investment managers, asset managers, so they can make ESG linked portfolios, etc. That's great. I mean, it's done a lot to make sure that in the boardroom, your clients have create a lot more focus on ESG and how they operate. The problem is that those rating agencies don't cover privately listed companies. And if you look at supply chain specifically, which is the area where we have been focusing on for the past 13 years, supply chain operators, your partners in the supply chain of your clients, are mostly small and medium-sized companies or not listed companies. So we have a unique capability to be able to provide ratings on companies that are not listed and that are not covered by any other ESG rating agency. Right. So corporates, Fortune 500 or Fortune 5000, have been talking to us. I mean, many of these are working with us. We have over 600 of these companies working with us to screen their suppliers on how they perform on sustainability. But it's very much like Anil talked about, carrot and a stick. A lot of these programs are about mostly the carrots. You know, you need to be transparent. You need to provide your rating because we want to see how risky you may be, and if there's risk, we want to act upon it, right? And so our corporate clients are also telling us that they are bombarded from a financial perspective to be rated themselves, and they are bombarded by their customers to be rated as well. And all this wild growth of ratings is a bit of a burden for the sustainability departments in your client base. Finance is getting more and more interested, and they want to be able to leverage ESG ratings for private companies. How can we develop new products leveraging ESG criteria so that we can convert traditional products like supply chain finance into sustainable supply chain finance? So this is how these both worlds come together, and how we got to talk to Anil, and looking for ways how we can link our rating into a lot of the financial products that are coming to market. Now, what are your clients facing today? Your clients are facing, and here's on the left, you see the bank's clients that are sending out requests to their suppliers to make sure they get a lot of information on their suppliers about CO2 emissions, about the Transparency Act in California, or about some labor conditions or audits. And suppliers are being bombarded by many clients. They don't work for just one customer. They may work for hundreds or thousands of clients. If each and one of them has their own way of rating their suppliers, it would be a nightmare for your customer suppliers. So what we have installed 13 years ago is a concept of having one methodology that is proof-based, that can reach out to any supplier, whether that is a plastics manufacturer or a clothing manufacturer, and we will determine what are the material issues we want to look at when we rate a specific supplier. And once that supplier is rated for one of our customers or one of your customers, that rating, that scorecard can be reused for him or her to share that scorecard with any other customer they may face. So the scorecards that we produce, and we have about 60,000 customers or suppliers of your customers rated today, those scorecards can be used in a supply chain context, but also in the sustainable supply chain finance context. But your customers can also use this in an ESG linked loan if they want. So that makes that over 13 years, we created a vast network of buyers and your clients buying from 60,000 plus suppliers and rating those and monitoring those suppliers on a continuous basis. So that's a great network for banks to tap into and develop sustainable finance products with. Now, how do we do that? When we look at sustainability, maybe we want to define what sustainability is or what ESG is when we rate companies. We don't just look at the environment, like Anil correctly said. Environment is important, carbon is important, but there's also many other themes that are burning today. Like as soon as the carbon agenda calms down a bit, it's about plastics in the ocean, or it may be child labor in your chain. So when you reach out and assess suppliers, or if you want to create ESG-linked products in finance, it is a dangerous or maybe immature way to focus only on one criteria when you create these products. Right? You may grant a sustainable loan based on a carbon input that you get from a certain company, and tomorrow you may find out that that company, however, having a good carbon performance, may be mistreating their employees in the factories. So you don't want that. You want to have a comprehensive view of the ESG-related material issues of a company and get a rating produced. Now, of course, in that rating, there's other themes like labor and human rights, ethics. It's about anti-corruption and bribery processes, anti-competitive practices, the use of information in their operations, but also their proper supply chain. Are your companies that you want to rate in function of a certain financial product, are they also including ESG criteria when they buy from their suppliers? Because many of your companies may just be one link within a multi-tier supply chain system. So when we do these assessments, we don't do this just based on a self-assessment questionnaire, which is unfortunately a lot of practice in certain industries that have traditionally moved very early in sustainable supply chains. And the practice of self-assessment questionnaires was typically to prepare for on-site audits. But on-site audits are relatively costly and heavy, and in the COVID-19 days today, on-site audits are pretty difficult to implement. And also these audits or self-assessment questionnaires don't really give you a quantified result to link with a loan, for example. You need to be able to have a rating methodology that helps you determine at which score you can give an additional incentive in the interest rate, for example. So we use a lot of the information the supplier can provide us. We will reach out to the company that needs to be rated, ask them for all the proof material they can provide on the management systems they should have or could have implemented on ESG. We will look at all that information and analyze it in great detail, and also include what we call 360-degree information, look at 100,000 plus sources of organizations, NGOs, or other sources that produce information about your suppliers on a daily basis. So we're using the digital nature and the ever more digital nature of the supply chain to corroborate what we see in the ratings. So we get that rating done and we publish it to your customer, to the supplier that gets rated, but also to the bank, so that the bank can determine what the incentive is that that supplier could get in financing their invoices early. In the scorecarding and in the rating, we do also provide information about what the company could or should do to improve their score. Not all companies are perfect. None of them score 100. None of them score 0 either. And in between 0 and 100, there's a lot of steps to take. There's always improvements to make, even for the best companies that we rate today. So out comes a scorecard with the quantified scores by theme, an overall score, but also a lot of information that you can report on and determine your product on. So your supply chain, sustainable supply chain finance product can be based both on an overall score, but also maybe on particular factors that we can produce. Let me see. And then, of course, all the information we provide in that scorecard. So important is for the bank to know that all this is based on proof-based information gathering and verification. It is not about self-declarative things that the supplier that gets their invoices paid early may claim to do, but cannot prove. It is not about what your customer says they think the supplier's performance is about. And that's one of the flaws, I think, from the early sustainable supply chain finance programs I see, is that the mechanics that determine the sustainability performance of a supplier are mostly done in-house by the bank's client, which is not necessarily a good ground for transparency for further stakeholder analysis. Right? For the rated companies, it's great that by being rated, they can get maybe more business and a better relationship with their customer, but they can also potentially now combine that with selling their invoices early, which is a positive incentive that is not necessarily existing all the time today. Right? So there's some good in it for all, for the buyers, your customers, for the funders, the bank, and the suppliers. I'll let you read through the slides. There's enough time to do that. I may be running a little bit out of time. So what are now the options you can use? I think there's some best practices that we can talk about to make sure that how can you link the objectives of the procurement department or the supply chain division with the treasury department and the financial goals you may have set, right? And you need to coordinate these programs. You cannot, to my opinion, have a program for responsible sourcing driven by one way in looking at suppliers, giving them objectives and rules about how you want to go about digesting their performance, and then have your finance department use another criteria to determine whether your sustainability now is good enough for getting access to finance. So I think that's the key thing. There's a number of ways in which you can link the score to interest rates potentially. I would say one that is not on the screen is maybe you want to give an incentive to all suppliers that are willing to be transparent to begin with, because sustainability and ESG starts with the willingness to be transparent. And then you can have any score grade that you and your client agree upon, which maybe certain benefits may trigger into action. And we also work with a middle concept, which may be also interesting to use, where the score there is more of a relative score. How does this company compare to, from a percentile perspective, to all the other companies that we have assessed, and making sure there's no adverse news that is so horrible that would mean that you finance this company on a certain absolute score, and even when there's maybe adverse news that you don't think is acceptable. So that's a bit the approach I raced through this. I realize there may be quite a lot of questions. I see some questions here. I don't know if some of the questions are relevant for me to answer. Okay, this seems like a huge list and must be expensive to collect. Also, consumer demands change. How do I make sure I don't run foul of changing trends? Now, that's a good question. I think what we have based our methodology on is making sure that the methodology we use is fully in line with the standards that are out there, like ISO 26000 that describes the scope of sustainability, ILO conventions, Global Compact, and other legislation out there that really defines what companies' ESG criteria should be that we look at. So you're right that once in a while there's another theme that gets more fancy. 2-3 years ago it may be the plastics in the ocean, which is horrible. Before the COVID crisis, it was all about climate change, and the world is burning, and the water levels in some places are so low that we can't do business. Tomorrow, it may be again on child labor or bonded labor. So yes, there's changes in flavors, and that's why I said before, it's better to base your ESG rating and your ESG linked products to a more comprehensive rating that is encompassing the total nature of ESG, adapted to the material issues of your customer, so that you don't start producing a project or a product that is just linked to plastics in the ocean, and tomorrow that product may not be fashionable anymore. Right? How do we verify the data provided to us? How can it be trusted? So we have an army of about 200 analysts in our organization that speak loads of languages and that are trained in various backgrounds. And we have a very thorough process through which each and every supplier or company gets rated. First there's the document analysis. We have a team of people that will go through the documents, make sure we understand what's in it, create metadata linked to those documents, making sure we know what those documents are, whether they're real, truthful, or maybe just very light and not saying anything. The second step in the analysis will be a scoring consultant that will go through the documents and take each material criteria by the time and look at how that criteria is covered by all the proof data that we have found. Is it water, carbon, is it health and safety, is it discrimination? Insofar it is relevant for that particular industry, the scoring consultant will use the methodology framework and look for how this company has really covered that topic in their management systems, including any third-party data and news that we can find, right? And then the third step is a quality control process where we do a lot of sampling and quality controls on the rating steps that I just described, so that we are sure about the reliability of the ratings. We monitor ourselves as to how many of those scorecards get contested by the rated company. We have a process where each and every company can have a complaint, if you want, about how this rating went and whether we have made mistakes. And so we keep that complaint process to below 3% of all companies rated, and the correction, which is the outcome if we would have made a mistake, is well below 0.6% of all the ratings that we do. But it's a very important factor that we track We also get audited by third-party companies on data privacy, on quality, and all other products processes that we proclaim to apply. So that's to third parties like customers or any other party interested in our quality, that we comply with all the stuff that we say we do. Not all of my suppliers understand their risks. Should I remove them given the risk this could expose me to? Well, I think it's a good question. I would not advise you to exclude them from the program, because then you are exposed. I think when we talk about the duty of care responsibility, you cannot just ignore a risk that may be in the supply chain just because your supplier claims not to be knowledgeable about all these things. A supplier to the companies that we spoke about, multinational companies that are typically the clients of the big banks doing supply chain finance, suppliers to those companies should understand the world in which they live. They should understand the impact they have with their operations. And so if they claim not to understand these risks, that may be an indication of their competency in doing business with you. Maybe a rough response, but I think that's where we need to go to, you know. I don't know if I can say which banks we have partnerships with. I was kindly invited by Deutsche Bank, but we of course talk with most of the big corporate banks out there, and fintech. There's also a concept of dynamic discounting for other applications. So we have been solicited by many large financial institutions, but that's one thing. The second thing we look at is how can we closely work together in a commercial partnership? Does the bank with whom we work have a real drive to make things happen rather than to learn from ratings and how can I make products? The problem with working with banks is that sometimes that may take 2-3 years before they really get into action. And so we're happy to work with Deutsche Bank and others, those that are really serious in moving forward.
Yeah, Wim, I'd just like to address a couple of those points that have come in. One major point that came in was the trust issue. Like I had mentioned, ESG is a paradigm change. What that means for a company and its operations is that it becomes part of the key performance indicators of not just a particular department organization, but it is equally valid for the finance department as it is important for the procurement department. So clients who have been open on their initiatives of this will put this as part of the requirement of the job that a procurement guy does. So in the annual conversations or the physical meetings that are held with the suppliers, they will be given a certain amount of material to check against, whatever criteria have been set up, or have been agreed with the supplier, which will, show that they're moving in a particular direction. So it's while Wim has explained how it is done at a larger level, at a macro level, there is micro checking also with the procurement department doing that from their point of view. So yeah. It is something, and the other question is, do we need to be scared from today as of tomorrow? No, this is a trend. It's a trend where we are all testing the waters. The corporates are testing the waters. Companies like Ecovadis are testing the waters. The banks are testing the waters. We're trying to figure out what is the best way we can help our clients in fulfilling their ESG goals and becoming a trusted partner to them. Because in being part of a ESG related supply chain finance program, we as a bank also obviously fulfill some of our own ESG requirements. So it is becoming something which is a crucial and integral part of the way we work.
Yes, I think to come back to that other question about what if my supplier or my supplier doesn't know anything about the risk they're facing. going through this assessment process for the first time is a very steep learning curve for them to understand what type of issues, what type of questions your customer, your bank, or maybe regulators and anybody interested in ESG may have relative to the activity you do. And that may be ranging from plastics production to oil and gas drilling to temp labor. And so the questions, of course, will be different, but going through the assessment for the first time will help the rated company understand what the issues are. So thank you in any case for all the interest. I hope it was helpful in some way. I know for many of the corporate companies and your customers, it is a new way in doing supply chain finance. Most of your customers, however, are already doing responsible sourcing programs. So for the supply chain side and for the procurement side, it's nothing new. The trick is, how do you link treasurers to talk to the CPO in the company? And how do you make this not only a commercial success for the bank, but also an impactful plan for your customer, for the bank, and for the world at large?
Okay, and as you've seen, that we're working on this from our side, from the supply chain finance business, actively. Wim is also obviously in the middle of the business. If there is interest in anyone in the audience today over here to have a deeper discussion on this, goes without saying, our email addresses are available, and we'd be happy to do a joint workshop with you, your team, your procurement team, and to explain to them how it works, how it incentivizes the supplier to do the right thing, how that obviously helps you as an organization to fulfill your ESG requirements. And of course, there's the added bonus. If in a supply chain finance program, you're able to increase your payment terms, and that improves the working capital position of an organization. So it's not just procurement, but it's also the finance function that benefits from them. With that, Wim, with your permission, I would like to say thank you to everybody, and hope to hear from you.